Whether it's learning about earnings estimates, exploring the Zacks Rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. This is the fourth and final installment in a series of commentaries covering the 4 factors behind the Zacks Rank. And today Steve will go in depth on the factor of surprise to help you profitably employ the Zacks Rank stock picking system. So without further ado, we bring Steve back in here now so he can explain this factor of surprise. And you know, when I said that, I almost expected the Muppets to pop up from behind here. You know, surprise! Yeah.
The stock market usually is not as interesting as the Muppets are, but they're a shade more profitable. So we'll tackle the surprise, I guess, without the Muppets.
Okay.
The definition of surprise in the way we look at it for the Zacks Rank is a company that reports a positive earnings surprise for the most recent quarter is more likely to have a positive earnings surprise in the next quarter as well. And then vice versa, meaning that a company that has a negative surprise in the past quarter more likely to have a negative surprise in the future.
Mm-hmm.
And this is very important for stocks that we're trying to figure out, trying to put things in our advantage and trying to have more stocks that are going to have positive surprises. And that's what we want in our portfolio.
Okay, sometimes being so close to this concept of earnings and earnings surprises, you kind of take for granted that most people are familiar, especially those who come to the website with any amount of regularity, about the whole concept of an earnings surprise. But just in case, could you just review that for us? What exactly is an earnings surprise so that we're all on the same page?
Right. I mean, let's move the stock market out of the way for a second. What is a surprise? And that is something that is unexpected. And so now when we apply that to an earnings surprise, well, what we expect is what we call the consensus estimate, so what all analysts are saying about the stock. And so when actual earnings come out, we compare the actual earnings to the consensus. And so let's just quickly roll through the definitions of what they are. So a positive surprise is when actual earnings are greater than the estimates. A quick example, the consensus estimate for a stock is $1 and actual earnings come out at $1.20. That is a positive surprise, and most likely the stock will jump on that news and go higher. A negative surprise is the opposite of what we just went through. So the actual earnings are less than the estimates. So Wall Street expected $1 for the company's earnings, and it came in at 85 cents. That's pretty bad news that earnings prospects are going lower. Certainly that stock is going to dive on that news. Mm-hmm. And so very important to have, you want these earnings surprises. Now, kind of an interesting historical note is that this way of measuring positive and negative surprises, this has been in place for about 25 years, the way we take a look at it. But in the 70s and 1960s, what investors used was a concept called standardized unexpected surprise, which was a mathematical model looking at the previous 20 quarters of earnings information, and then given the average growth rate during that time, trying to extrapolate that into the future. That was fine for companies that had very consistent, steady, like 12% growth rate every quarter, but for the vast majority of companies, it was not very valuable. So it was actually the work of Len Zacks who introduced this idea in the early 80s, and it's been in steady adoption since. So just kind of a feather in the cap for Len Zacks and our company.
Indeed. So then how does the factor of surprise help investors pick better stocks?
Yeah, there's multiple benefits in it, both a short run and a long run benefit. So let's talk about the short run benefit.
Okay.
Every 90 days, right, every quarter, there is another earnings announcement for a company. And it can be either a joyous time where our companies are having positive surprises, we're making money, or we're getting beaten up and our companies have negative surprises and we're just bleeding red from that event. So obviously we want to get as many of those positive surprises as possible. The concept of having earnings surprises, those companies that had earnings surprises in the past are more likely to have in the future. You want those stocks in your portfolio that had positive earnings surprise in the past quarter. And here again, the larger the surprise, the better it will be, so that when the actual earnings come out, we have the odds in our favor of having a positive surprise and the stock going up, and trying to avoid as many as possible of the negative surprises.
What then is the long-term benefit of that surprise factor?
It's something that the academics call the post-earnings announcement drift, and I have to admit I kind of laugh every time I say that. It sounds like something you should consult your physician about.
Yeah, really.
But actually it's a very positive thing. The post-earnings announcement drift is saying that a stock that has a positive earnings surprise will generally outperform the market over the next 9 months. Conversely, a stock that has a negative surprise is usually going to underperform the market over a 9-month period. So in other words, it's not just that initial pop that happens when the earning news comes out. It continues to, as they say, drift or continue to have an effect on the stock over a 9-month period of time. Behind the theory, they say that it's because investors continue to underappreciate the value of good earnings. And what I say it is they underappreciate the concept of earnings momentum. And what I'm talking about here is the momentum that happens inside companies. So I'll give like 2 quick examples. When Google first came out, when they first IPO'd, they were one of the hottest companies around. Their company management had a great vision for the future, employed great strategies, created great products, customer satisfaction was phenomenal, hired the right people. Everything's going the right direction. That's a positive momentum that can just keep a company going the right direction for a long period of time, quarter after quarter after quarter. And if you remember all the earnings surprises they had, they IPO'd at like $80 and they ran all the way up to $600. Right. That's the kind of positive momentum we're talking about. Unfortunately, there's negative momentum as well. And so this is the one I think most investors are least familiar with, because what happens, we buy these stocks, we fall in love with them, they come out with a bad earnings report, like a negative surprise, the stock goes down, but we say, oh, I still like this stock, and probably it's just a 1/4 problem. But no, it's not a 1/4 problem. This is negative momentum taking hold. So everything I said about Google, now do it in reverse. The company has the wrong vision for the future, the wrong strategies, the wrong product mix, the wrong customer level of customer satisfaction, and so on. And that takes a lot of time and energy to reverse. So the post-earnings announcement drift, the long-term benefit of earnings surprises is because you want companies going the right direction, and to avoid those that are headed in that wrong direction, who knows how long it's going to take until they can right the ship.
So where then can investors find this earnings surprise information for their stocks?
Yeah,
he asked.
Yeah, just like the rest of the estimates information on the site, we have that inside a research report that we call estimates. So here again, find your way to it. Get on the quote page or any research page on Zacks.com. You'll see a drop-down box in the upper left-hand corner. Click on that. I have highlighted in the blue the estimates page, and so we're going to go there. On that page, you're going to have the consensus estimate and all the other factors, the Zacks Rank we've talked about. Today, we're concentrating on the surprise. And you'll see here we have a section that shows what actual earnings versus the estimates have been for the last 4 quarters. And for the stock that I chose here, First Solar, as you can see here, you have a 44% surprise the most recent quarter, 21%, 36%, 37%, 190% surprise. I mean, this is a company that's been going the right direction for a long period of time. And let me assure you that after each one of these earnings surprises, it indeed saw its consensus estimate go up and indeed saw its stock price jump on the news as well.
Interesting. So now we've covered all 4 factors behind the Zacks Rank. Where does surprise stack up with the other 3?
Yeah, we went through them in their order of importance in the way that we calculate them in the Zacks Rank. So agreement does make up the majority of the value of the Zacks ranking here, and that's the agreement of the analysts and the direction of earnings estimates. Then followed by magnitude, and so the percentage difference. So here, a 20% movement in earnings estimates is more powerful than a 5% movement in earnings estimates. Now, surprise and upside, the one that we covered last, they're about dead even in terms of the relationship. So I guess the important thing to point out here is that Len Zacks, he's a mathematician, okay, and so he needs things that are verifiable fact. There's no fluff in the Zacks rank. Each one of these individual elements has benefit. So therefore, if agreement has a higher weighting than magnitude or upside and surprise, it's in there for a good reason. Okay, so and here again, if surprise didn't have any value, it wouldn't be in there at all. So each one of these things does have individual benefit, and an investor, if they were to employ any of them individually, would have an edge over the market. But the beauty is where they all come together inside the Zacks Rank. And instead of, here again, looking at all these different data points, okay, well, let me check out the agreement on the stock, let me check out the magnitude, let me check out the upside, let me check out the surprise, coming together in a clear signal. 1 is a strong buy, 2 is a buy, 3 is a hold, 4 is a sell, and 5 is a strong sell. Very clear signals of what to do given the changes in these factors. And that's why it works so well together.
The numbers don't lie, as they say. And there you have it, Zacks Rank factor number 4, surprise. With Steve Reitmeister, I'm Terry Ruffalo.